If you're a CRT trader and losing trades pointlessly, you need to watch this video. I am here to teach you about candle range theory and two essential CRT candlestick-based concepts. How these concepts work, why they matter, and how you can leverage them to validate trades, minimize losses, and score big wins. So without wasting the time, let's dive straight in. The first concept is candle closure. So what are candle closures? Imagine we're analyzing a 1 hour chart. Each one of these candles represents the price movement during 1 hour. At the end of the hour, which is the start of a new hour, this candle closes and a new candle forms to represent the next hour. And at the end of this candle, we have this close and open at the start of the next hour. So the candle closure is where a candle closes and the next candle opens. This is the opening price, the price where a new candle starts. And this is the closing price, the price where this candle ends. So this is the candle closure. Here, 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 and here. Every time we are looking at a candle, we see two parts, the wicks and the body. Wicks represent attempted price movements that didn't hold. This long wick above this candle's body suggests the market tried to go higher but faced rejection, and it got closed here. This indicates the only confirmed price action within this range is this open and this close. Always wait for a candle to close before making trade decisions. A closure provides confirmed price action and a clue about what will happen next. So we just need to wait for the candle to close because its price movement isn't set in stone. It can go up or down and reverse at any time. By waiting for confirmed closures, you can avoid buying into false breakouts or unconfirmed moves. For example, imagine the market is in an uptrend, a series of higher highs and higher lows. You see the market forms a new high, then pulls back slightly to form a higher low. After a pullback to this low, the market pushes up again, appearing to break above the previous high. If this candle closes above this high, it confirms the continuation of the uptrend, making it a good time to consider a buy trade. However, if the candle reverses before closing and falls below the previous high, it shows a rejection. This means the market failed to sustain higher prices and could indicate a shift towards a downtrend. And that's the point. Imagine we are looking at a 3-hour chart. In this case, every 3 candles on a 1-hour chart combine to form one candle on the 3-hour chart. On the 3-hour chart, these 3 1-hour candles are merged into a single candle that starts at the opening price of the first candle and ends at the closing price of the third candle. Similarly, the next 3 1-hour candles form the next candle on the 3-hour chart, starting with this candle's open and ending with this candle's close. Now the next candles are the determining factor. But how? In this chart, imagine the first candle as the range candle of a CRT pattern, so we expect the price to trade its range. But first, to confirm a presumed CRT pattern, we need to spot the accumulation phase and recognize a manipulation phase. So when the price reaches this high, it goes up and down around this area exactly like this move, which is likely to go up, but it is getting rejected, so it creates a resistance level here. And if the price returns to this level, again, buy stops will accumulate above it and sell stops below it, which will form an accumulation phase here. In order to recognize the manipulation phase, the next candles must push the price higher than the accumulation phase, which is here. And the point is, if the next candles break this range but reverse before closing and fall below the range and closes below it, this means it is all the market makers' plan. They push the price above this level to induce traders to enter long. They manipulate the price to reach this high to trigger the buy stops above this level. So to confirm the manipulation phase, we need to see the next candles of the 3-hour chart break this level by the wick and drop to close below it. This confirmation is referred to as the surpassing range. To confirm the surpassing range, we need to look for the current time frame of the range candle. This means if our determined range candle is in the 3-hour time frame chart, for example, this candle. So we need to look for the next 3-hour time frame candles to see a candle surpass the range with its wick and closed below the range. Exactly in that current time frame, not in the lower or higher time frame. But what do we expect next? As we mentioned before, a long wick above a candle when it closes below the previous high signals a potential downtrend. The same thing happens when we confirm a surpassing range, so now we expect the price to start a downtrend, which we define as the distribution phase. According to the candle range theory, we can trade the distribution phase if we've correctly confirmed the previous phases, accumulation and manipulation. That part of the work is already done. Now it's time to find an entry point. But where should we look? The primary focus should be on the manipulation phase of the same chart to identify a potential entry. If no clear entry is found, the next priority is to analyze the one time frame lower. We can continue examining lower time frames until we identify an order block to enter the trade. Now, what if the third candle closes above this range? If this candle in the 3-hour chart closes above this range as we analyzed previously, it means the price does not confirm the manipulation phase, and this candle close above this level signals a continuing uptrend. Before we continue this concept, let's take a look at the real chart examples. After the price dropped approximately 140 pips, it began consolidating during the ASEAN session. Before this session ends, just ahead of the London session, it briefly dips below this consolidation level but closes above it. This is a rejection, which could be a signal of a potential uptrend, right? Now, since I prefer trading with a range of more than 10 pips, we will focus only on candles whose range exceeds this threshold. So let's start with this specific candle. This is the candle range low, and this is the candle range high. So we see the next candle starts trading lower, but after it breaks this level, it just closes above it. So this is not confirming the surpassing range, and it is just signaling the continuation of the uptrend, so we cannot trade its range. This candle range has already been traded without showing us a clear manipulation phase. But the range of this bearish candle has a break below this level, and it is a clear manipulation phase. Already we are in the 30-minute time frame chart, and there is no bullish order block. But in the 15-minute chart, there is a clear order block, and we can easily trade its range successfully. Again, we have a bearish candle and a clear manipulation phase here, and a clear order block here. So let's execute a trading order, but this time I have some advice. As we are trading this candle range, we should exit at this level, but if we look back, we can observe there is a liquidity level that the price is trying to reach. So if you can take more risk, go higher below this liquidity level. And again, if you can take more risks, to manage this trade, you can watch the price action to see if a candle is reversed to become a bearish candle and it violates the previous candle. That's where you have to exit fast. If you're trading based on candle ranges and struggling to make consistent profits, it's possible you're missing a key aspect or approaching it the wrong way. If you want to master the candle range theory and learn how to apply it effectively, subscribe to the channel for more detailed insights.